Good day, Junior Tikkies. We're going to look at activity 5. This activity is going to focus on gearing. Now, if we look at gearing, we're looking at, is the business more reliant on own capital or borrowed capital? So the financial indicator which we always use with this is the debt equity ratio. The business is owned by two partners, Gillian and Hannah, and is located in Pretoria. They want to open another branch in Cape Town and will need funding. They will need to borrow 400,000 in order to expand. Required, calculate the owner's equity amount for 2022. Should the business consider taking out an additional loan? Explain using figures to support your answer. And then the third question, if the business decides not to take out the loan, but to rather bring in another partner who would provide the additional capital needed, how will that change their financial risk? Explain. Question 5.1. To calculate the owner's equity amount for 2022. The debt equity ratio was given to us 0.7. Remember, debt equity is in a ratio and it's always 2:1. So to find out your debt equity ratio, you have to take your non-current liabilities divided by your equity. And they've asked us to calculate the owner's equity. Non-current liabilities were given 350,000. To find out your equity, we have to take 350,000, because it's your non-current liabilities, divided by your equity, which is now X, equals 0.7. So to find X, we have to take 350,000 divided by 0.7, and that equals 500,000. 5.2. Should the business consider taking out additional loan? Explain using figures to support your answer. They want to borrow an additional 400,000. So if we now answering this, currently our loan amount is 350,000, which means if they borrow an additional 400,000, the loan amount will increase from 350,000 to 750,000. This means that my new debt equity ratio will be 1.5 to 1. 750,000 divided by 500,000, which we've calculated is my owner's equity, equals 1.5. This means now that the business will have a high financial risk. They are more reliant on borrowed capital than own capital. The interest on loan will increase from 63,000 per year to 117,000. Interest is calculated at 18% per annum. The interest on loan is less than the profit earned, as the final return on equity is 21.4%. But if interest goes up and the business does not increase their profits, then they could potentially earn less than the interest on loan. So we're comparing the interest on loan with the return of 21.4%. We are still what we call positively geared. So now we can answer yes or no. Should we borrow? And based on this, we shouldn't. The next question, if the business decides to take out the loan, not to take out the loan, but rather bring in another partner to provide that additional capital, how will this change the financial risk? So if we then take the loan, the non-current liabilities, 350,000, it now needs to be divided by our owner's equity, which will be 500,000 plus the 400,000 which the partner will contribute. So the new debt equity ratio would be 0.4 to 1, which means the financial risk is low. we will be more reliant on own capital than borrowed capital. I hope you have a better understanding of gearing, the debt equity ratio, and take note of how it could be asked a little bit differently than what you are possibly used to. I want to leave you with this quote: 2 things you are in total control of in your life are your attitude and your effort. Have a wonderful day.